Taking all these factors into consideration, the RBI has estimated that real GDP growth for the next year to be at about 6.7%, with Q1 at 6.7%, Q2 at 7%, Q3 at 6.5%, and Q4 too at 6.5%. The risks are evenly balanced. Coming now to inflation, headline inflation, after moving above the upper tolerance band in October, has since registered a sequential moderation in November and December, standing at 5.2% now. Going ahead, food inflation pressures, absent any supply side shocks, should see a significant softening due to good Kharif production, winter easing as we witness every year in the vegetable prices, and a favorable Rabi crop prospect. Core inflation is expected to rise but remain moderate. Rising uncertainty in global financial markets, coupled with continuing volatility in energy prices and adverse weather events, presents upside risks to the inflation trajectory. Taking all these factors into consideration, CPI inflation for the current financial year is projected at 4.8%, with Q4, the current quarter, at 4.4%. Assuming a normal monsoon, CPI inflation for the financial year 2025-26 next year is projected at 4.2%, with Q1 at 4.5%, Q2 at 4%, Q3 at 3.8%, and Q4 at 4.2%. The risks are evenly balanced. I will now come to the external sector. India's current account deficit moderated from 1.3% of GDP in Q2 of last year to 1.2% in Q2 of this year, 24-25. According to the World Bank, India, with an estimated inflow of $129.1 billion, continues to remain the largest recipient of remittances globally last calendar year 2024. The current account deficit for this year is expected to remain well within the sustainable level. As on 31st January this year, I may inform you, India's foreign exchange reserves stood at 630 plus billion US dollars. This provides us an import cover of more than 10 months. Overall, India's external sector remains resilient as key indicators stay robust. I would like to mention over here, and especially because there has been commentary in the media about the Reserve Bank's exchange policy. Well, the Reserve Bank's exchange rate policy over the years has remained very, very consistent. Our stated objective is to maintain orderliness and stability without compromising market efficiency. The Reserve Bank believes in the market efficiency of the markets that we have in India for Forex. Accordingly, our interventions in the Forex market focus on smoothing excessive and disruptive volatility. It does not target any specific exchange rate level or band. The exchange rate of the Indian rupee is determined by market forces, and we will continue with this policy. Coming now to liquidity and financial market conditions, I may state that after remaining in surplus from July to November 2024, system liquidity as measured by the average net position under the liquidity adjustment facility did turn into a deficit during December 2024 and January 2025. This drainage of liquidity is mainly attributed to advanced tax payments in December 2024. You are aware there are quarterly advanced tax payments to be made, December being that particular month. for the advanced tax payments for Q3. That did have an impact. Capital outflows, again, one has witnessed some capital outflows because of various reasons. Forex operations, and a significant pickup in currency in circulation as we witness every year in January. It has been, however, I would like to mention over here that we have observed that some banks are reluctant to on-lend in the uncollateralized call money market. They are passively parking funds with the Reserve Bank. I take this opportunity to all the banks to urge them to actively trade amongst themselves in this uncollateralized call money market, so as to make it deeper and vibrant for better signal extraction from the weighted average call money rate. The Reserve Bank is committed. I want to assure everyone that the Reserve Bank is committed to provide sufficient system liquidity. We have taken a number of steps in this regard, and we will continue to monitor the evolving liquidity and financial market conditions and proactively take appropriate measures. I repeat, proactively take appropriate measures to ensure orderly liquidity conditions as may be required for the system. And when I say liquidity, it means not only transit, overnight liquidity, but also durable liquidity to meet the requirements of the system. I now come to financial stability. The system-level financial parameters for the scheduled commercial banks continue to be healthy. The credit deposit ratio for the banking system at the end of January 2025 was at 80.8%, broadly similar to that on 30th September 2024. Bank liquidity buffers are sufficient, though the net interest margin moderated, return on assets and return on equity are robust. The system-level parameters for NBFCs too are very healthy. I also take this opportunity today to mention that the Reserve Bank has been observing Financial Literacy Week annually since 2016. This is with the purpose to enhance financial education in our country. Last year too, we did this campaign. This campaign was focused last year on empowering youth adults. This year, recognizing the critical and multifaceted role of women in society, this campaign will emphasize on women's role in financial decision-making and household budgeting. I sincerely urge all banks to actively participate in this campaign on the theme Financial Literacy, Women's Prosperity. It starts from 24th of this month.